There are moments when markets are tested. A blockade of Taiwan would not be another geopolitical headline or a tradable risk premium. It would be financial Armageddon by non-nuclear means, a rupture so deep it would not simply reprice assets but force the world to reconsider what money actually is. In that storm, gold would not inch higher or grind upward on technicals. It would explode, repricing violently toward levels that today sound unthinkable, $5,000 or $6,000, perhaps well beyond. Yet embedded within this inevitability is a brutal distinction that most investors ignore until it is too late. In a true sovereign crisis, not all gold is equal. The difference between protection and illusion will not be measured in ounces, but in how those ounces are owned, stored, and controlled. To understand why, one must first grasp why a Taiwan blockade is unlike any crisis modern markets have experienced. This is not the Gulf War, not the global financial crisis, not even the pandemic. Taiwan sits at the nerve center of the global technological and industrial system. Its semiconductor fabs are the unseen backbone of automobiles, defense systems, artificial intelligence, telecommunications, and consumer electronics. A blockade would fracture this system instantly. Production lines would halt. Inventories would evaporate. At the same time, the world's busiest shipping lanes would become contested waters, choking nearly half of global container traffic. Overlay this with sanctions warfare between the United States and China, two economies together accounting for over 40% of global output, and what emerges is not instability, but systemic dissolution. When systems dissolve, complexity dies. Contracts fail. Promises are questioned. Only assets with no counterparty risk endure. That asset has been physical gold in every era. A single narrative would not drive gold's ascent in such a crisis, but by three immense and converging forces that feed on one another. The first is human panic, the raw and timeless flight from uncertainty. When war breaks out between nuclear-armed powers, algorithms and risk models become irrelevant. Value at risk collapses precisely when it is needed most. Capital does not flee into cash, because cash is someone else's promise. It flees into certainty. History offers no ambiguity here. Gold surged during the late 1970s amid geopolitical chaos and inflation. It spiked after the collapse of Lehman Brothers as trust in financial institutions vaporized. It reached new highs in 2022, despite rising interest rates, as war returned to Europe. Yet those were contained shocks. A Taiwan blockade would be global, systemic, and existential. Equity markets could lose a quarter or more of their value in a day. Bond markets would seize as volatility overwhelms leverage. Trillions of dollars would scramble for safety at once, and gold would not absorb that flow gently. The move would be vertical, a reflexive stampede into the only asset with no issuer and no expiration date. The second force is monetary collapse, quieter in language but more devastating in effect. Wars are not paid for with savings. They are paid for with currency creation. Missiles, drones, cyber defenses, logistics, and industrial mobilization require deficit spending on a scale that peacetime politics cannot tolerate. Both Washington and Beijing would aggressively monetize debt, whether openly or through financial repression. The result would be structural wartime inflation, not only in energy and food but across logistics, insurance, and supply chains. Central banks would face an impossible choice. Raise rates to fight inflation and implode government finances, or suppress rates and absorb bond issuance through renewed quantitative easing. Either path leads to the same destination, profoundly negative real interest rates. This is the environment in which gold not only performs well, it dominates. Gold does not respond to inflation alone, but to the erosion of real returns on paper assets. In a prolonged conflict, negative real yields would not be a temporary policy error. They would become a permanent feature of survival economics. As confidence in the US dollar's neutrality erodes, gold reasserts itself as non-sovereign money, beholden to no central bank and immune to sanctions. The third force is the most underappreciated, yet potentially the most explosive, the sovereign stampede. Since 2022, central banks have been accumulating gold at the fastest pace in half a century. This is not a coincidence. The freezing of Russian foreign exchange reserves sent a shockwave through every non-aligned capital. It answered a question many had never asked aloud: reserves are only yours until they aren't. Gold, held in your own vaults or in trusted jurisdictions, cannot be frozen with a keystroke. In a Taiwan crisis, this accumulation would accelerate into something far more aggressive. China, sitting on trillions in foreign exchange reserves, would have every incentive to reduce exposure to U.S. Treasuries and dollar-based assets. Even a partial reallocation into gold, executed quietly through bilateral deals, offshore vault swaps, or commodity for metal arrangements, would overwhelm the thin annual supply of newly mined gold. This would not be a retail frenzy. It would be sovereign command of the market, where price becomes a consequence rather than a consideration. Against this backdrop, the comforting abstractions of modern finance begin to crack. For many investors, gold means a ticker symbol, most notably GLD. In calm markets, this abstraction works beautifully. GLD tracks spot prices, offers liquidity, and integrates seamlessly into portfolios. But in a true systemic crisis, GLD is not gold. It is a financial instrument designed to function within a legal and banking framework that may itself be under stress. In the early stages of panic, GLD would likely surge alongside spot prices. Volume would explode. Everything would appear normal. Then reality would intrude. Retail holders cannot redeem GLD for physical metal. Only authorized participants, major banks, can exchange shares for bullion. If those banks face balance sheet stress, regulatory constraints, or geopolitical exposure, the arbitrage mechanism that keeps GLD aligned with physical gold can fail. At that point, the ETF can trade at significant premiums or discounts, not because gold is mispriced, but because trust in the redemption pipeline has fractured. More troubling still is the nature of custody. Much of the gold backing ETF sits in unallocated accounts within the London bullion system. Unallocated does not mean fraudulent, it means ownership is a claim, not a specific bar segregated in your name. In a banking failure, a legal dispute, or a government intervention, that claim becomes vulnerable. History is unambiguous on this point. In national emergencies, governments change the rules. Redemptions can be frozen. Taxes can be imposed. Transfers can be restricted. A U.S.-listed security exists squarely within U.S. jurisdiction, and jurisdiction matters most precisely when you want to escape it. Gold mining equities introduce yet another layer of complexity. They offer leverage, sometimes extraordinary leverage, to rising gold prices. But they are businesses, not bullion. In the initial phase of a crisis, they are sold indiscriminately with the broader equity market. In later stages, they face operational threats that physical gold does not: energy shortages, supply chain breakdowns, labor unrest, and political risk in host countries. Mines can be taxed, regulated, or nationalized. Gold cannot. Miners may offer upside, but they do not provide sovereignty. The most significant risk, however, is not market malfunction but monetary transformation. A prolonged U.S. China confrontation would accelerate the emergence of parallel financial systems. Trade would increasingly bypass the dollar, settled in local currencies or through gold-linked arrangements. Digital settlement platforms outside Western control would gain prominence. In such a world, physical gold becomes the neutral bridge between systems. Paper claims denominated in a fading reserve currency lose relevance, while bullion held in trusted, accessible jurisdictions gain strategic value. For the investor navigating this terrain, the path forward demands clarity rather than bravado. Paper gold instruments have a role. They provide liquidity, tactical exposure, and convenience in stable conditions. But they are not the foundation of resilience. That foundation is physical bullion, held in allocated, segregated form, with clear title, auditability, and the ability to withdraw or transfer without permission. Jurisdiction matters. Storage in politically neutral, financially stable regions is not paranoia, it is prudence. In the final reckoning, gold will do what it has always done. It will not save portfolios because of a number on a screen. It will preserve wealth because it exists outside the system that is breaking. Prices may reach $5,000 an ounce or more, but that figure is almost incidental. The real test will be practical and unforgiving. Can you hold it? Can you move it? Can you exchange it when trust has evaporated? Gold is not about price. It is about power, the power to settle, to endure, and to remain solvent when promises fail. When the lights dim on paper markets and confidence drains from currencies, only the metal itself will shine, heavy with history and indifferent to politics. Thank you.